Hey everybody, it's John King with Summit Funding, and it is Friday, the 21st of April, and I'm coming to you with my weekly market update, talking to you about what's going on in the world of mortgage and real estate and finance. So I am looking forward to giving you another great update today. So 4 topics that I'm going to talk about. The first topic that I'm going to talk about today is are buyers with good credit really paying higher interest rates? There's been a lot of noise on social media over the last week about this, and so I'm going to talk about what the truth is, and we'll discuss that in depth. The second thing we're going to talk about is how failed banks are driving up interest rates this week. It's kind of an interesting dynamic that you'll find to really be impacting mortgage rates right now. I'll talk about what that means. The third thing I want to talk about is trigger leads. What is a trigger lead? Is it good? Is it bad? And should they go away? And what's happening in Washington, D.C. right now that is likely to impact trigger leads? And then the final topic I want to talk about today is, are we going to see Dream for All funds coming back? And an outline on some alternatives to Dream for All funds and some information that I'm providing on that as well. So let's go ahead and dive in and talk about these 4 topics. Here's the deal. Recently, we've seen a lot of noise on social media about home buyers paying higher interest rates when they have good credit compared with buyers who have lower credit. There's some truth to that. There's a lot of truth to that, but it's a little bit distorted. So here's what happened. And there's also an issue with the dates. So the federal government, Fannie Mae and Freddie Mac, announced earlier this year changes to their risk adjustments called loan level price adjusters. And those changes impact what is your credit score and your down payment percentage, or really what your loan to value is, and what impact that has to the fee that you pay on your mortgage. Now, I'm going to bring up right now a chart. And if you take a look at this chart, it basically across the top has your loan to value. So on the far left, you're going to see 0 to 30. That means, well, 0, you wouldn't be getting a loan. But if you were putting down 90% of the purchase price and we were loaning you 10% of the purchase price, you'd be in that category. On the far right, you see greater than 95. That's if, for example, you were putting a 3% down payment and I'm loaning you 97% of the purchase price, then your loan to value is greater than 95%. Across the left from top to bottom, you're going to see the top tier credit score being 780 to the bottom credit score being below 620. Now, the green areas represent improvements. An improvement in the mortgage world is a decrease in cost. Improvement is a good thing for the borrower. And so what you notice is that, for example, in the bottom left corner, we have improvements of 0.5% cheaper fee for someone who has really bad credit compared with someone that has great credit. Now, what's the deal with that? The Biden administration is incentivizing the Fannie Mae and Freddie Mac regulators to say, hey, we want to help the underserved. Well, they've said for a long time it's not fair for somebody who has a lower credit score to pay a higher interest rate because that person has been disadvantaged. They might be in a lower income bracket, and that's why they haven't been able to pay their bills on time, and that's why they haven't had a good credit score. And I'm not judging. I'm just saying that when you look back at this chart, you see that the lower credit scores are where the improvement is coming in. They're incentivizing people, pretty much if you're below a 660 credit score, 680, excuse me, you are getting better terms today than you did yesterday. Now, there's an issue about the date of when this rolled out. It's effective May 1st. Not really. It was effective 2 months ago because it's effective for loans purchased by Fannie Mae or Freddie Mac on or after May 1st. Well, that means we funded the loan 30 days ago because it takes about 30 days to get from when we fund the loan to when we sell it to Fannie Mae or Freddie Mac, which means we started applying this to lots back in March. So this is not something that's going to make interest rates jump a week and a half from now on the 1st. Nothing is going to change. These impacts are already built into the rates. We built them in about 45 days ago. But this chart that you're seeing here really shows you that the red areas are where we're being most negatively impacted. So you're seeing someone who has a 759 credit score that's putting 15% down payment, even 19% down payment, is paying a 0.75% higher fee than what they would have paid 6 months ago or 3 months ago or 2 months ago. Why is that? Why are we punishing the people that have done a good job in building their credit? And really that whole swath of people that are being charged higher fees are the people between 680 and 779 FICO scores. Now, another interesting fact is this chart used to cap out at 740, meaning if you were 740 or above, you got the best deal. Well, now they've added 2 extra tiers. And they've said, no, we're gonna dissect it a little bit further. And people who have between 760 and 779, well, they're not our top tier either. And only if you're over 770 or 780 are you going to be our top tier. So it's a pretty significant change. But as you look at this chart, you'll see that yes, you're going to pay a higher fee, which sometimes simply translates to a higher interest rates. In the mortgage world, a cost can either be paid as a one-time fee up front, or we can charge you a higher interest rate over the life of the loan to offset that cost, which is why the news articles are saying that people with better credit are going to be paying higher interest rates. They're not going to pay a higher rate than the person with worse credit. The person with the lower credit is still have a more expensive adjustment. And that's the second chart that you're going to see right here, where you see that, hey, when somebody has there's no colors on this chart, but when somebody has a lower credit score and depending upon where their loan to value is, their fee they're paying is definitely more expensive than someone with a higher credit score. But it used to be a bigger difference. It used to be the people with a higher credit score got a significantly better deal, and the people with the lower credit score didn't. And they're basically having the people with the better credit pay the cost of the loans and the rest for the people with the lower credit. So that's a pretty significant change. There's absolute fact behind these social media articles and posts that are going around out there, but I wanted to give you the real story to help you understand exactly what's going on. Now, moving on to our next topic for today, here's what I want to cover. How have failed banks driven up interest rates this week? And it's actually a pretty fascinating topic. So here's what's going on. Banks that failed, so we're talking about Silicon Valley Bank, not Synchrony, whatever the other bank is, sorry. Anyway, the failed banks that have been taken over by the FDIC, they are owners of mortgage debt. Now they have to, the FDIC says, look, we're not trying to keep these assets, we're trying to sell them off to pay back the insurance that the federal government paid out to protect the depositors. Let me say that again one more time. When the federal government takes over a failed bank, they pay back the depositors to make them whole. Again, that was normally up to a limit of $250,000. With the most recent bank failures, they said, we're just going to pay an unlimited amount. We're going to cover whatever is required to keep those depositors whole with every dollar they had in the bank. We're going to ensure that, and we're going to give them that money at a new bank. But what happens is that they now take control of the assets. The federal government takes control of the assets of the failed bank, and they sell those assets because that's how they recover some of the money that they put out to cover the losses of the bank. Now, a big component of those assets is mortgage-backed securities, loans of borrowers, of people in the United States that borrowed money. It was packaged up into a pool and it was sold, and the bank, Silicon Valley Bank, bought a bunch of these mortgage-backed securities. Well, now the government has to sell those. And what we've done is we've basically added a huge supply of mortgage-backed securities into the market of buyers wanting to buy mortgages. Now, how does that impact interest rates? It's actually super simple. It's like anything else you are trying to sell. If there's a bunch of people trying to sell the same thing, then the value of what you're selling goes down because the buyers can be more picky. As an example, if you're selling a car and at the time that you're selling a used car, it might have been in 2020 when there weren't very many used cars for sale and couldn't buy a new car either. So therefore the price went up. But if tomorrow a whole bunch of people put their used cars up for sale, then guess what? Every buyer has a lot of choices and they say, you know what? I'm not really interested in buying your car because there's 42 other ones that I could buy and they're either a little nicer or a little bit cheaper. So you've got to lower the price of your car in order to get the few buyers to pick your car compared with all of the other ones that are for sale. Well, that's what's happening right now with mortgages, is that there's a huge supply of these mortgage-backed securities that have to get bought by the few banks that are willing to invest in mortgages right now. And that means that if they're spending money to buy those, they're not as willing to buy the new mortgages that are being created today, which is driving the interest rates up on the new mortgage that are being created today. There's a second component to this, which is Wells Fargo has been historically one of the largest buyers of mortgages, and so has the Federal Reserve been one of the largest buyers of these mortgage-backed securities. But guess what? The Federal Reserve stopped buying mortgage-backed securities last year, and they've been talking about selling some of their portfolio. Well, that's going to create an even bigger problem, because not only do we have the government selling the portfolio that belonged to Silicon Valley Bank and the other failed banks, but we've got the government that might be selling their portfolio or some of their portfolio of mortgages they had been buying over the last few years. But Wells Fargo also made an announcement in January that they're pulling back on mortgages, including the fact that they're going to decrease the size of their portfolio of mortgages that they own, which means they're about to flood the market. And they've been selling some, but they're about to flood the market at some point in time with a lot of mortgages, which again, the more that the mortgages are being pushed into the open market for sale, the fewer buyers there are to buy the brand new mortgages that are coming out, and that's driving up interest rates. So it's just a unique phenomenon that I want to make sure you understand when you think about the dynamics of interest rate. Sometimes there's some wild card things that are going on that are continuing to change rates outside of what we would normally expect the dynamics to be. All right, trigger leads. What the heck is a trigger lead, and what does it mean to me as a consumer? What does it mean to your realtor? What does it mean to your lender? Is it a good thing? Is it a bad thing? And should they go away? So let me explain. A trigger lead is anything that you do related to your credit that your credit bureau, Equifax, Experian, and TransUnion, the credit bureaus can sell information to companies, to banks, to financial institutions based on something you did, called a trigger. So it's a lead. They're selling your information to say, hey, this person just inquired about buying a car. Well, gosh, if you inquire about buying a car, then a car loan bank would want to know that so that they can reach out to you and give you an offer about buying a car. Maybe you just moved, and so you've got, or you just, I don't know, something. I mean, I'm trying to think of other things other than mortgage. There could be something about, hey, you just paid off a credit card and closed the account. Well, that might mean that you're ripe for new credit cards. Matter of fact, here's a good trigger. You just filed a bankruptcy. Now, why would a bankruptcy be a good trigger? Because there are credit card companies that charge super high interest rates that specifically target people that just came out of bankruptcy. Why? Because you can't bankrupt them. Once you've gone bankrupt, you can't immediately go bankrupt again, so you have to pay them back. So they get a trigger that says, hey, anytime the credit agency finds out that you filed bankruptcy and your bankruptcy is completed, I want you to notify me, and I'm going to go after that person to offer them some credit. That's called a trigger lead. There's a trigger, something that happened, that turns into a lead for a financial institution. Now, how does that apply to mortgages? Super simple. Whenever you apply for a mortgage right now and I pull your credit, the 3 credit agencies sell your information to any bank, any mortgage company that wants it. Now, there's a lot of mortgage originators like myself who we get our business through relationship. I get my business through my relationships with my real estate agents that trust me and they tell their clients to trust me. I get my business from business people who trust me. I get my business from YouTube, from people listening to me, believing that I understand what I'm doing and I'm good at what I do, and that they want to trust me to help guide them and take great care of them. That's how I get my business. But a lot of other mortgage companies don't go that route. Instead, they say, well, gosh, isn't it easier to just fish in the pond where the fish are jumping right out of the water and into my boat? Because why should I go after the general population when I can focus my efforts on people who have already raised their hand and said, hey, I'm buying a home? And so there is a problem. When I pull your credit, you end up having your information sold to tens to hundreds of companies, and your phone and your email and your text message is bombarded for 2 to 14 days. Because these companies are going to do whatever they can to convince you that they can do something that I can't do. Now, this isn't self-serving about me. It does impact me, but it's about the industry. And it's about choice is good. Having the ability to choose is absolutely important. And everybody that chooses me, I don't mislead you. I don't want to force you to use me under any false pretext. But the fact is, you had a choice to use me, and you took a recommendation, or you did your own due diligence and you chose me. These companies are trying to prey on the fact that you're at the last minute, you're right now about to go into contract, you're writing offers, and they're going to tell you whatever you need to hear in order to decide to use them. And the federal government has realized this is a problem. There is a bill in the Senate that was just passed through the Senate. Doesn't mean that it's going to end up going, or the House, whatever. That doesn't mean that it is going to become a law, but it's proposed to ban trigger leads for mortgages. What does that mean? Well, what it means is that when you go to buy a house, when you have your credit pulled, you're not going to be bombarded by hundreds of phone calls, voicemails, text messages, and emails trying to get somebody to say, oh, by the way, yeah, you know that you're working with John King at Summit Funding. They use our names. They make you think they're one of us, and it's very, very misleading. And so that bill will decrease the friction that is caused with these trigger leads. Honestly, there's opportunity for you to shop and compare. You don't need to have 100 people calling you in a 24-hour period in order to be able to shop and compare. And it's impossible to know who to trust when you're getting bombarded with inbound phone calls. So trigger leads to me are not a good thing. And I'm hopeful that this passes and that it becomes a law so that my clients, so that you don't get bombarded with these issues. Final issue that I want to talk about today is Dream for All. The California Dream for All program, as you well know, went away in 8.5 business days. There was a state Senate subcommittee meeting yesterday on the 20th that specifically had an agenda item talking about Dream for All and kind of what the future is, what happened with it. They were pretty vague, but I'll tell you that I got some really clear understanding that there is more money that is going to be allocated. There's already been allocated for the budget year that starts July 1st of 2023. Now, there's another $300 million that's been allocated, and I shared about 5 minutes worth of my thoughts on that. So when you get in a couple of minutes, and within a minute, I'll be done with this video, and at the end, you'll see a screen that pops up. Click on that, and you'll be able to see my 5-minute video about what I saw, what I think is going to happen, when I think the money is going to be released. I think it's super, super important for you to stay in the loop. And if you are not already subscribed to my other channel, my California Dream for All channel, when you click on that video in a moment, you'll be taken to that channel, and you can subscribe there as well to stay up to date, not only on the California Dream for All program, but all first-time home buyer programs. Speaking of which, I also have a video today that I've done about the Platinum program. It's an alternative to Dream for All that has some really cool features that help people who are medical workers, that are first responders, that are educators, and some unique features that help people who are employees of particular counties. So I explained that in pretty good depth to understand how that program works. And the coolest thing about that program is you don't have to be a first-time home buyer. So if you want to watch that video, the link is down below. You can check that out. It's also on my other YouTube channel as well as an alternative to Dream for All. So I really, really appreciate you listening to me today. I hope you have an absolutely wonderful weekend. Please share this video, like it, subscribe to my channel if you haven't already subscribed, and click that notification bell so you get notified anytime I put out new videos. And make sure to do the same with my other channel, which you should be seeing right up around here, or maybe around here. I'm not sure. One of these sides right about now, you're seeing that pop up. Click on it, watch the next video. Have a wonderful weekend, and we'll talk to you soon. Bye-bye.